Today, we are excited to have Javier Corominas joining us on Sampro TV. Javier Corominas is head of global macro strategy at Oxford Economics. He's a senior macro and multi-asset investment strategist with 2 decades of experience in active portfolio management as well as independent macro research. Previously, he was a director and head of research at Record Currency Management, one of the largest institutional currency managers in the world. Javier holds both a first-class degree and a master's in philosophy and economics from Cambridge University. Javier, welcome to the show. Thank you so much for joining us.
It's great to be here, Ty. Thanks very much for having me.
So, a lot to talk about today, but one of the things that our readers and watchers are really interested in is, what President Trump has done in his first, 8 months of barely 8 months in office, not even 6 months in office, has really, people have argued, has changed the international or dismantled the international economic system more than anyone since World War II. Before that, we had Republican, Democratic presidents, but economic policy was fairly predictable. And he's really turned that all on its head, particularly with his system of tariffs, moving away from, at least, the Americans have always championed free trade. Has this changed the international paradigm, particularly how foreign investors and people from other countries think about the United States today and going forward? And I love having your view on this because you're not based in the U.S., so you'll see a different view from most Americans.
Thanks, Ty. That's a really good question, actually, and something that we've been getting a lot over the last few months, of course. So I have a slightly, different take from the purely political angle here that says, Trump does X, therefore it means Y for the dollar as a reserve currency. I think we need to take a much broader, bigger picture here. Let's, maybe start with defining terms. You talked about sort of the dollar hegemony there, and I think if by that you mean the dollar as a world reserve currency, as the world reserve currency, is that being challenged? It's being fundamentally challenged. And the reason is because there can only ever be one global reserve currency, and that's the dollar. And so for me, I'm looking at 3 metrics in the way that I define a world reserve currency status. One is the ability to project overwhelming military force, and the US has that. Some competitors, perhaps China, perhaps can have that as well. But there are 2 other reasons that I think make the US still stand out despite Trump. One is the fact that, there's a net supply of safe, let's call risk-free assets out there that foreign investors can buy. The U.S. is the only country in the world with the capital markets that are liquid and deep enough, in particular debt capital markets, to offer that global liquidity to the rest of the world. Now, that sometimes means you have to run a current account deficit, but not always. I think the key thing here is that, unlike China, the U.S. is able and willing for foreigners to hold its debt, something that I think China is perhaps unwilling rather than unable to do for reasons we can get into. And so that's a real key differentiator, I think, in this debate. And that also means that currencies like, for example, the Swiss franc and the yen may be hard currencies, flight to safety currencies, but they're never really going to be world reserve currencies. There isn't just the depth of capital markets and liquidity to have that. So, we could go on for a long time here, but I think those are the 3 key reasons why I think the U.S. still has that kind of global reserve currency status, and it's going to be like that for a while. That's separate to the question of whether the dollar is going to rise or fall, and we can get into that.
I want to drill a little bit further in this, and I have often thought, and I think you've said it a lot more eloquently than I have, is the fact that we have so much outstanding debt that the world is willing to buy makes dollars worthwhile. And as a matter of fact, if you wanted to have, would it be accurate to say that if you wanted to have reasonable risk-free returns, the U.S., I think our debt is probably 6 or 7 times that of the European Union, and if you want something that gives you a decent return, where are you going to go? And it's the U.S. because actually we have so much debt. Is that generally accurate?
Yeah, absolutely. And it's I think it's even perhaps even more nuanced than that, because that availability of a return may not even be the prime issue for foreign buyers. Where I stand outside the U.S., the main requirement is that you have a safe and liquid asset vehicle to park your cash. That if that gives you a positive real rate of return exposed to inflation, that's great. But I actually think that's not even the core fundamental driver of it. It's the fact that there's ample availability of risk-free assets for foreigners to buy, and that has typically come with an ex post real rate of return, and that's certainly the case still going forward compared to, say, some of the Eurozone countries or Japan or some of the other debt markets globally. So, at sort of 24 trillion of marketable debt outstanding, that is, orders of magnitude higher than the next sort of three debt markets of Italy, Germany, and Japan and the UK put together. So certainly the US stands out in that regard.
Since we're talking about U.S. debt for a long time, I mean, almost as long as I can remember it, because it's been so long. Every time yields, or certainly I guess since the Great Financial Crisis, maybe to be more accurate, every time yields went up, you just bought bonds. You could trade TLT like that. Buy TLT on every dip, and it worked out for you. But that's changed over recent months and years, where certainly there seems to be a more reluctance to buy longer term U.S. debt. Is that a paradigm change in terms of either concern about inflation and the bigger and bigger pile of U.S. debt that's outstanding, or is it something that will eventually correct itself? And what I remember is the so-called PIGS countries like Portugal, Italy, Greece, and Spain. 12, 13 years ago, the yields were very high. The euro looked like it was going to break up, and Mario Draghi rode in and saved it all. And now I think all of those countries, their 10-year yields are at below the U.S. So, is this, sort of higher, longer term yield? Do you think that is here to stay for a substantial period of time, or eventually people say, you know what, we need yield, we're going to buy that stuff again?
Let me try to unpack that. I think the first sort of answer to this is that the US is at the moment in an unsustainable fiscal path. And that will come to you as a revelation, because I'm probably the first one to tell you that. Obviously not. So therefore, that's been known for a while. So the reason is what's changed, right? Why are people not just buying the dip right now? And I think there's been a couple of things. One is, if you look at the structural buyers of U.S. treasuries over the years, it used to be foreign central banks, say foreign official sector, Fed plus banks, say captive holders, structural buyers, price insensitive buyers, were about 75% of the treasury market. That's now just dipped below 50%. That's quite a significant move over time, over the last sort of 15 years. And that has an effect at the margin, because suddenly you have to find, for every $2 of debt, $1 will be bought, but the other dollar is not necessarily going to be bought unless it's the right price. At the moment, I think for us, the curve steepening that we've seen, which is a way of saying, people aren't buying the dip anymore, it's something that we've been writing about really for 18 months. And that piggybacks on this notion that the structural buyers of US debt aren't there anymore, coupled with the fact that, in a sense, the Fed is now going to engage in a rate cutting cycle. And so that tends to coincide with rising term premium. So that also adds some dynamics there. And also, fundamentally, more recently, questions around Fed independence. And by that, I don't mean is the Fed independent or not as a binary, but more around, are there pressures to run slightly more lax monetary policy than warranted by financial conditions, such that inflation is then slightly stickier at a level that's above 2%, and then the bond market has to price that in. And I think that's increasingly a world we're moving towards, which is a world of say, fiscal dominance, right? So the central bank has to accommodate whatever the Treasury or the fiscal authority wants to do, as opposed to the other way around, which was really the era that I grew up in, and most of our viewers probably grew up in, where the Fed set the inflation rate, and the Treasury had to make sure that the integrity of the Treasury system was preserved. Now that's been flipped. So we're in a different world. I think that has political economy reasons for it, in the sense that the AI productivity boom means that a lot of people have to become dependent on the state to some degree. So those fiscal deficits are here till the eye can see. And that's the problem, I think, that needs to be priced in by markets. So we're now in a permanent situation of 5 to 7% deficits, rather than any attempt at correcting that back to what would be called sustainable levels. And that's what, over time, needs to be priced in by markets. So people are still buying the dip, but it's just every time is at an incrementally higher level of yield. And so if you look at a chart of the last 10 years, that's why the yield that is going up.
Right. I mentioned this in the beginning, and I just want to get this more, maybe a political economic question, is, sitting in Europe, do you feel that Europeans or big buyers of U.S. debt and equity, are they looking at the U.S. like, Trump is, and not putting words in your mouth, words in my mouth. Is he a fever that will be broken in, in a little less than 4 years? Or have they changed the way that they think of America and Americans? Because, oh my goodness, if this happened once, it could certainly happen again. And that relationship, transatlantic relationship that we've depended on since the Second World War is irreversibly altered.
I think I have to agree with you there, Ty. Just as we learned, just as Trump essentially set the agenda in his first term for a more China hawkish policy, which stayed under Biden, in fact, increased. I think Europeans have realized that the same is going to happen with this. So whether it's J.D. Vance that wins the next election or someone else, or even on the Democrat side, I think Trump, for better or worse, has changed the terms of the debate. And so, when he leaves office, it will be I think, part of the U.S. policy agenda, not to be completely isolationist, but to certainly pick and choose their battles, much more focused on the U.S. national interest, defined by people in Washington. And so I think Europeans have realized that. And that's why it was very unusual for the Germans in particular to break their debt limits in such a way as was done by Merz in February, in March. And this is why the markets reacted quite, with that. We saw that move obviously in Bund yields, the largest move in 30 years, plus all the defense stocks as well have, outperformed massively. And that wouldn't be the case unless markets thought this was a serious affair now.
I mean, I fear that, that we're right in this in terms of some people have argued, I think, we continue to be a great power, but we've stopped being a good power, which is in some ways a shame, but we'll see what happens. And people have said that for good or ill, Trump may be the most consequential president since FDR. For all the changes that he's made. Now that we've sort of set the stage, I guess for our sort of second half, I want to ask, given all the things that we've talked about, in the short to medium term, which I would say perhaps 3 months to 2 years, and then the longer term, which is unclear, but sort of longer term, what regions and what regions and or countries that and then we can get maybe if we want to get into if you want to get into sectors, that would be fine as well. But what regions of the world do you think investors, or many of our watchers and readers are investors, where should they be allocating when they're thinking about allocating? Countries, regions, what do you like in the short to medium term and then perhaps longer term?
At Oxford Economics, I essentially get paid for coming up with it's the right views, both medium term and short term. And so maybe let's start with some of those short term views, I think, which help our clients sort of participate and profit from markets. I think one is, I think Japan is a very interesting story from an equities perspective because of the corporate reforms that have been going on in particular. But I think outside equity markets, what's really interesting is how does the BOJ in particular resolve the potential issue it has with the long end of the curve. So as you've probably realized, 30-year JGBs above 3%, very much unheard of at a time when debt to GDP ratios are basically considered unsustainable by many economists. Now, one of the things I think that is interesting here is what does a JGB do? The longer it delays in hiking, the more the potential there is for sort of a weakening of the yen, which therefore could drive further JGB market volatility at the long end and higher yields, which prevents structural buyers from coming in because the volatility is so high that they can lose out on 30 bips in a few weeks. And that is obviously a very big game changer for them. So I think what the BOJ does is very interesting, and how that will affect the long end of the JGB curve. We think, yields are still on their path up. And so that is for us a very clear opportunity there. I think elsewhere in the world, looking at the UK, UK equity markets look particularly cheap, but they have continued to be cheap for a while. I think you need to look at the UK again from a political economy perspective, and I think selling the pound is, I think, one of the more straightforward trades that, in our view, that comes from the political economy situation. So you think about, and again, some of your global readers may not be very familiar with this, but essentially the UK is in a very compromised situation in terms of its fiscal woes. It has a particular fiscal targets that it's not going to be able to meet, given the fact that it can't cut spending. We're in a situation where the labor market's weakening, inflation is sticky, but potentially set to fall. And at the moment, the degree of cuts that are priced into markets are not large enough, I think, to justify the potential cuts that could be coming. And so the cleanest way for us to express that view is really through a short sterling position. So we think that the pound vis-a-vis the dollar, but through other currencies as well, is set to fall.
Would it be accurate to say we should sell sterling yen?
That's an interesting one. So those are both currencies that are potentially set to fall, but I still think sterling falls. Sorry, okay. Yeah, I still think sterling falls more than yen in this scenario. There are other markets out there which I think are quite interesting as well. So we talked about that sort of issue of hedging before, and to what extent that's being done. And one of the things that we're recommending clients is that they look at, in particular, at emerging market high yield debt, but also high yield currencies, in particular Brazil and Mexico. One of the things that's really interesting is that the effective tariff rate that we're seeing is actually quite different from the statutory tariff rates that have been announced, be it because supply chains are being rerouted as we speak, or companies are exploiting exemptions in particular. So for Mexico, the effective actual tariff rate that we've seen is 4% only. And they're also seeing some of the taking market share from China and other Southeast Asian countries. So we think Mexico, but let's say Brazil as well, given its high real interest rates, are very attractive destinations, funded in particular by, let's say, Asian low-yielding currencies. So a Taiwan dollar-based funding of long Brazil and Mexico positions, I think is quite interesting. The move in the Taiwan dollar post the sort of one-off increase in the hedge ratios has now played out, and it's in the interest of the central bank there to keep the currency relatively stable. So we think that yield pickup in the context of that positive macro trade story, I think is really interesting. So that's something that we're talking about. Finally, if we just focusing on the US, let's say the big picture, if you look at, let's say, the four things that are going to dominate the next few years. So fiscal monetary policy, of course, the tariffs, and the AI boom. The AI boom and the fiscal story, I think, are long-term and medium-term positives in terms of growth for the US. Monetary policy now is shifting in that direction. So what you're left with is the tariff risk. But as I've just sort of mentioned, I think the effective tariff rates that we're seeing are probably lower than the statutory ones, which means the one-off hit to inflation is not going to be as large as people expect. It's just going to be more, let's say, drawn out and more persistent, but it's not going to be so spiky. And in that situation, I think we've got the conditions probably akin to the late 1990s, where we're set up for a pre-bubble phase in equity markets. That's how we're looking at it. So there will be corrections and pullbacks along the way, but this is by no means the end of the story, despite the high valuations that we currently have. And so we're saying to clients, there are various ways of capitalizing on this, perhaps through option structures and others, but we're not yet at the moment where I think markets have completely topped out in this cycle, even though the cycle is quite mature. And so we could be in a 1998 situation now, despite the valuation. So that's something that we really think about sort of quite hard in terms of our client recommendation.
I want to just get back to some of your FX rates, and sterling has had a thanks to the sort of weakness to the dollar, quite the rally so far this year. What's the sort of where do you think if the UK needs to do what it needs to do, where do you think an equilibrium rate for sterling dollar would be in, say, 3 to 6 months or that kind of time frame?
Interestingly enough, sterling is really appreciated against the dollar because everything else has. So it's much more of a dollar weakness story than a sterling appreciation story. For us, anything above 130 is sterling being too high. Long-term, our valuation measures, which include things like productivity growth, relative terms of trade, rather than just simple purchasing power parity metrics. Probably anchor us in the sort of 120 to 125 level max. So we're seeing a potential opportunity for a 5-10% move lower in sterling based on those fundamental valuations.
Let's move to dollar yen, and I have a personal bias in dollar yen. I was trading dollar yen, derivatives in 1994, and that's when it collapsed. So I literally can't be long dollar yen. It makes me very, very nervous. Which is why when you said the BOJ was going to, would potentially, have to hike, I thought, maybe it's time to buy yen again and sell dollar yen. It's always in my mind. So, what are you thinking about dollar yen in that kind of similar time frame?
I think there's something we need to talk about first, which is everyone reflexively, including myself, doesn't want to buy dollar yen when we think we're approaching risk-off periods, right? And that sort of makes sense reflexively because you think, look, the Japanese have the highest amount of dollar cash assets deployed abroad, the current account surplus. This is a flight to safety currency, as we talked about before, et cetera, et cetera. The only thing is that hasn't really panned out for the last few years, has it? And there's a couple of things there. One is the Japanese have really been buying dollar assets on an unhedged basis for a while now, certainly since the COVID pandemic broke out. And the reason is because the FX hedged yields, and so we're getting into slightly more wonkish territory here, but the FX hedge yields, that is, if Japanese investors wanted to secure a dollar rate without any FX risk, that would be negative. They have been just buying U.S. assets, taking a naked FX risk, and that, in a sense, feeds on itself because the more people do that, the more the yen depreciates, the more people do that again, and so that has led to this huge uptrend in dollar yen from about sort of the low 100s to where we are now. The high 140s. And the question then becomes, what happens when these investors potentially repatriate back to Japan? You get a big spike in the yen. We saw that in 2024 in August. But I think that carry unwind is much less of a risk now, because the position buildup is much less. But also because with the market, with the current volatility in JGB rates, I think maybe retail buyers, but certainly not structural buyers are they're not racing to repatriate flows back into Japan. As I said, with the current bond market volatility that exists, it's very difficult to convince people that they're going to capture a yield which may be unfavorable in a couple of weeks' time, and so that's dissuading people from buying. So I think the structural story in dollar yen persists in terms of over the very long term, dollar yen is up because there's no other way out. How does Japan square its growth circle without, we've obviously the consumer not spending and the sort of, let's say, unwillingness of, I don't want to use this word, but let's say a deep-seated aversion to not save and to take out debt means fiscal has to take over that mantle. In a world of rising interest rates, if the Bank of Japan doesn't want to deliver on what it needs to do, then the only escape valve is for the yen to weaken. And so I think that's the way Japan manages its way out of this over the next sort of decades. It's how much yen weakness can I tolerate such that inflation doesn't really ramp up to sort of unhealthy levels. And if I can manage that equilibrium, then I'm fine. I don't fundamentally care about the level of the yen itself, only to the extent that inflation then shoots up beyond the levels that I want to. But if inflation is, above their target, let's say between 1% and 3%, I think that's fine. And so the markets will then piggyback on that and sell the yen. And there's a further element, final element here, which I think is the rate differential story. So when looking at spot yen, we often forget that you can lock in very favorable yen rates if you start from a country that has much higher interest rates than Japan. And so if spot is 148 now, you could have a forward rate which is 145 in a year's time, and that over time means that being short the yen, even if spot doesn't move much, can still be accrue value to you as an investor.
You're sort of buying forward in the backwardation, if we want to use a commodity language in it. I mean, that's interesting, and they have a lot of other issues in terms of their population and things. That makes a lot of sense. It's just hard for a guy like me, but I always want to buy yen.
Yeah.
And I a couple of things I want to get to, but any passing thought on China? which, you look at equities in China, and it is, kind of a frustrating trade. It, sort of doesn't go anywhere. Do you just pass some thoughts on, are they doing what they need to do? And, in a situation where they probably have similar issues to Japan in terms of demographics in the coming decades.
Yeah, that makes sense. So China, I mean, we take a step back. I think probably China's just been through its own version of the GFC, right? Since 2021 with the collapse of Evergrande in the housing market. That's the way I look at China. So they are stuck in a debt deflation, low growth, low nominal growth sort of setup for a long time. And I think the authorities recognize that, which is why their efforts at tentative stimulus aren't so large as they were, say, in 2016. Even the most recent announcements. So that leaves a couple of options. One is obviously yields are very low. So you end up going to either gold, we can talk about it later if you want, which is what we saw in 2022, 23, or you go into the equity market. And so the problem with the Chinese equity market is essentially a retail-driven market. There's very few structural long-term buyers of Chinese equities. And so for us, it's very much an in and out trade where you might see a multi-month opportunity based on valuations. And then you play that, and then you potentially get out. So it's very difficult to analyze the Chinese market just based on traditional metrics. I think at the moment it seems to be that the retail flows have really come a long way, and so I wouldn't be chasing the upside right now in China at the moment.
Fair enough. I want to get your thoughts on this. Is the Mag 7 are, I think, approximately 35% of the market capitalization of the S&P 500, and about roughly, I want to say about 30% of the net profit. That seems to me, or very, very heavily skewed. Is that good? It seems like when we have sort of market leaders, the market generally can rally more easily. Maybe people all pile into the Mag 7, which is, I guess, what people have done. So is it good? Is it sustainable? Or is there going to be some sort of significant correction?
There's always been concentration in U.S. equity markets, and almost by construction, there have to be leaders that are increasingly market cap, and that's why you get a pyramid structure in terms of the weighting. We're now at a level which is excessive, right? If you look at historical norms, even compared to previous bubbles. I think the question is whether we've now turned neutral, U.S. equities. We think the bubble, let's say pre-bubble phase, is still with us. It's just that at the moment, we see an opportunity tactically to stay neutral. But I think the question is whether the Mag 7 for us is receiving favorable treatment by this administration. And that's really going to change things, whether it's the tax depreciation on the investments, which we've seen come through, whether it's the lack of semiconductor tariffs, et cetera, et cetera. That means that the Mag 7 are really still, poised to benefit much more than some of the small caps out there. And so as an investor, it's really unavoidable. But we also think the political economy setup for now is such that it's very much pay to play in the U.S. equity market. And so, we're in a situation where those companies have been favored, and they have the ability also to pay to play if needed. And so that can sustain valuations, certainly for a while longer. But having said that, tactically, certainly throughout till the end of the year, we're neutral at the moment in U.S. equity.
Yeah, I mean that bounce from the April lows has been truly remarkable, and I think that the retail people beat the professionals in that one. I don't think any of the professionals saw new highs for some time after that kind of drawdown. I want to go a little bit to what you think about some alternative asset classes, and then maybe you wouldn't call gold alternative, but gold has been actually quite range bound over the past few months, but overall has had a tremendous rally over the last, since the middle of 2022, when it came about that the Chinese central bank was buying substantially, perhaps in reaction to the fact that most of the world in the United States froze Russian assets after the Ukraine invasion, saying, well, if they did that to them, maybe they could do that to us. A tremendous run. What do you think of gold in the medium to long term?
Yeah. So I do subscribe to the view that there is a political economy angle to the recent surge in gold, and certainly over the medium to long run. I mean, we turned bullish gold in October 2023, and on a structural long-term perspective, we remain bullish. And the reason is because it's the only real true inflation hedge out there, but I want to nuance that because it's not a CPI, a sort of traditional high street inflation hedge. That's not what it is. And in particular, gold is also subject to the travails of risky assets too. So if we had another financial crisis, gold would sell off very much so as well. It's much more that gold is a sort of a hedge against monetary debasement over the long term. Maybe call it monetary inflation. And that's where I think investors that seek protection have a reliable, the tried and tested 5,000-year-old track record in an asset class such as gold. So we certainly think it has a place in portfolios. At the moment, positioning is a bit extreme. We not only saw Chinese central bank buying, but also retail investors, as I mentioned earlier, in China really ramping up demand a couple of years ago, given the lack of alternatives. So certainly it looks a bit stretched, but if you have a time horizon that's beyond a year, certainly it has a role in portfolios simply because it's no one else's liability, right? So gold is your asset, no one else's liability. So gold will certainly do well against traditional fiat currencies. Is gold going to be the best performing asset? No, most likely not. But is it going to provide a ballast to portfolios in a world where the stock bond correlation is shifted? It is now positive and bonds aren't exercising that role anymore. I think for sure. And so, the institutional take-up of gold is relatively low. It peaked out basically in the 70s, and it's, well below what we would consider, sort of allocations of, let's say, 5% as being reasonable. And so there's still scope for the gold market certainly to deliver returns over the long term.
I like that point where it's an asset. It's no one's liability. It's actually a very, very good way of thinking about it. Javier, thank you so much for spending so much time with us. For your thoughts on where to put our money, and answering some really important questions about equities and about bonds, and how we should be thinking about it. So I look forward to having you back on the show again.
It's been a pleasure, and look forward to speaking again.